Welcome to Salty Investors episode 3. I'm Scott and the bloke down there is Tim. How you going, Tim?
Good.
Good. So Tim, as usual, we'll kick off with a bit of macro stuff today, and we've got David Rosenberg. Do you know David Rosenberg? Well-respected economist. You don't know him. Well, that speaks highly of him. But, you know, well-respected economist is kind of an oxymoron, isn't it, really? But anyway, he said that the Conference Board's leading economic indicators down 6 months in a row has been a precursor to every recession since 1959. So it's all done and dusted. We're having a recession. Now, of course, the problem with these sort of things is that the number of instances, so your N is basically about a dozen recessions since 1959, something like that, Yep. So, it's not... But, it's just another sort of indicator. The Conference Board... So I had a couple of charts of the Conference Board stuff. So there you can see with its... that's just the last 3 recessions. Obviously, it leads the recession. It starts going down. But obviously you can get some false signals here and there. 11, we got sort of a false signal, but that's a fairly significant leg down, so it's looking like recession could be coming. And the next one's sort of, that it's given the recession signal, basically what Rosenberg has said. So it's got a pretty good track record. But
the lead time's different, I noticed.
Let's see, probably...
The lead time's all over the place on that,
Yeah.
Some of them it's a couple of months, some of them it's a couple of years.
Yep.
Yeah.
Yeah.
But that's when it's negative.
Yeah, there's another... Yeah. Yeah. So that's only the last 3. I mean, they probably look a lot worse except for 08, in, the early 80s, probably one looks pretty bad. The early 90s probably doesn't because, we had a pretty bad recession in Australia. It was pretty short and shallow in the United States. But yeah, just interesting. And I thought because we'd just get a quote from Stanley, because Stanley's now become a friend of the show. We had him on last week.
He'll
See,
be
in my
listening,
experience,
for sure.
I don't know if it's just because... Absolutely. In fact, I called him before this and tried to get a quote. No. He... Years past, I mean, Druckenmiller didn't say a lot publicly, and I don't know if it's just because now there's so many different forums to get, comments out and things. But he seems to be saying more recently. I don't know if I'm just noticed, or I don't know, maybe it's just me. But he's saying we're in deep trouble. He doesn't rule out something really bad. It's not going to be... wouldn't be surprised if it's not just a garden variety recession. And then he has a go at the transitory bullshit, which we now all know was crap. Transitory $5 trillion in stimulus. What do you expect, basically?
Yeah.
So that's from Stanley. So, I mean, at the end of the day, this is all very interesting stuff, but what does it actually mean? Markets discounting it? How much have they discounted? I don't know. What do you reckon, Tim?
Yeah, I don't think they're fully taken into account. You see all these heavyweights coming out and saying, we're not really looking at this properly, Yeah. 5 trillion, on the fiscal and QE, and they haven't even started the QT. Like, that's a lot to come down there. 5 trillion in QT. And we've seen from just in London overnight what's happened there. So they're not going to start QT over there for if ever. I don't think it's ever going to come back. So yeah.
I didn't say at the top of the show, this is Thursday the 29th of September. So and markets have shit themselves in the UK, or more likely people have shit themselves unnecessarily, but
I don't think anybody's too keen.
Yeah, 5 trillion in, which was yeah. I mean, the latest handout from the US government was called the Inflation Reduction Act, by pumping shitloads more money into the company. It's got to be the most ironically named bill in history, hasn't it? The Inflation Reduction Act.
And they wanted more, remember?
Latest round of fiscal stimulus.
Build Back Better
US.
didn't happen.
Oh, yeah.
Like, this was like the...
No, that's right.
This is the low end. This is what we've got, you know. Imagine what happened if we got the, you know, the full ask, you know. So
yeah. The full lot, yeah.
A full measure of help, or stimulus. Like, oh well, what can you do now?
Yeah. And I thought, just on the domestic side in Australia here, it's worth, because we've been talking in the last 2 episodes about when will the Fed pivot, when will the RBA pivot. So the RBA, these are the RBA minutes, and the RBA minutes are very long and boring. I just cut out some things I thought were right at the end, because you can basically skip to the end if you just want to know what they're thinking. So they did discuss at the last meeting whether to go 25 or 50. So it looks like, you know, they're already considering that, and they said that obviously monetary policy operates with a lag, and that you know, they still expect to increase interest rates, but not on a preset path, which is where data dependent. That's what that means. And the full effects of higher interest rates have yet to be felt in the broader economy. So it clearly looks like they are. I mean, they're not pivoting to cutting, but they're definitely going to slow down the rate of increase. You know, just the bottom bit's data dependent. All else equal, members saw the case for slower pace of increase in interest rates as becoming stronger as the level of the cash rate rises. So the consensus now is, I mean, I think Bill Evans, who's, you know, been around at Westpac for so long, he's part of the furniture, now says 50 basis points cut in October and 25 in November, 25 in December, no meeting in January, so 25 in Feb, gets you to 3.6 and they're done. That's basically what he's saying. That sounds, you know, who knows? I'm not hanging my hat on anything else, but given that that markets have consistently underestimated inflation, I mean, they still could be, but it's clearly there's a talk of slowing down, definitely.
But couldn't they look silly? You know, they got the transitory thing wrong, and then, you know, if they're not hiking,
yeah,
you know, to fight this, they're going to look dumb, stupid. You know, in a couple of years, they're going to look totally incompetent on the other side. And then they don't want to come out with like 100 or a 200 basis point hike, you know, to really, you know, and then everyone will blame them for. There's going to be no soft landing then, you know, like. So I don't know. Will the market turn around on this? What do you think? Do you if they? I'd rather not, because I'm just speculating. I have no clear view of what, you know. I just still feel like there's more of the same in store, which is that the market keeps trying to anticipate this thing. Yep.
That's they've consistently underestimated, and you know they've still haven't fully grasped. They're still when's the turn, and they're, you know, and that's, but actually things could get a lot worse before they get better, basically. And so, I mean, bear markets, you know, for the uninitiated, are you know, dominated, or how to say it better. Typically, bear markets all the time are punctuated by these short, sharp, strong rallies up that fail in the end, and we end up at new lows. And every time there's like, oh, this is it, you know, this is it, and it, you know, it keeps disappointing people until they sort of give up, and that's when capitulation comes. And we definitely haven't seen that yet. I mean, everyone says going on about how awful this year is, but I mean, your average bear market since this is US bear market is 31% decline, I think. Last I saw, that's post World War II declines. we're not down that far yet on the S&P. So this would be a shorter than average bear market if we'd seen the bottom. I saw this morning people talking about a double bottom because the US was up overnight. Oh, we've got a double bottom. And I'm just like, if it is, given the extreme levels of valuation in the US market, I mean, you're getting off really lightly. My view is still there's further to go on the downside, but we will see.
Yeah, I'm holding back.
What do you reckon?
I'm not allocating. Like, might be a dumb move, but you
dry powder.
Really I just, yeah. I'm thinking, free cash flows aren't that, and I think earnings are going to get corrected a little bit here. Like, we still haven't seen that come through. I know FedEx, yes, we've been seeing that, but that hasn't really flown on to others yet. I'll have to wait and see. And earnings season.
Toll.
Oh, okay, Toll's coming.
Toll Brothers, not Toll Transport here in Australia, but Toll Brothers, one of the largest home builders in the US, or the largest might be. Their new orders have fallen off a cliff. I just saw. That was in their latest earnings call. That sort of 60% new orders. So housing's and this is a guy. His name's Eric Cinnamon. He's a fund manager. He runs something called Palm Valley Capital, I think. Lives in Florida, and he's got mortgage broker mates, and they just said that activity's sort of just stopped, And he said there are people that are still delusionally just pricing their houses like it's 2021, not taking into account the interest rate rises. I saw here in Australia, I saw somewhere else, I don't have the... Go ahead.
Oh, used car, the same thing. They're still, banks are repoing cars and they're still selling them at 2021 prices and keep rolling them over and not discounting them to get them off the lots. And so it's like, well, at some point when inventory gets out of control, that snowballs into the price because everyone then runs to the exits, So,
Yeah. So I saw new home sales in the US. The average inventory is something like 8.5 months. That's above average. I think normally average it's sort of 5 or 6 or something like that. And the worst it got was in the financial crisis when it was 12 months or something like that. So it's elevated. It's above average. I remember, US housing, you can't really have a recession in the United States without US housing tanking, and I think it affects 20% of the economy, something like that. Economic activity, in some way, is associated with housing. And just another factoid to throw in. I think someone said that I saw... Because I think the median income in Australia is $90,000 a year. Is that right? And that a household that has a household income of $180,000 a year, their borrowing capacity has now been reduced by something like $200,000, just through interest rate rises.
Wow!
So a year ago you could have borrowed $200,000 more if you had a household income of $180,000. So that just goes to show you what interest rates do. And we haven't really felt the full effect.
Yep, lagging indicator. Lagging effects on the economy.
Yep. All right, that's macro taken care of, I think. So let's get into some... Oh, yeah. You want to run us through this one? This is a log chart.
Yeah, so I thought, wow, wouldn't it be interesting to see, what is a long-term market look like? Is there any plateaus? Like, do we have to sit not earning anything for a certain amount of time? And you can see here, I know it's hard to look before 1950s, different monetary policies and things like that.
But 66 to you
can see them from the 60s, to 70s. Basically went nowhere, but everybody doesn't take into account. Yes, no one takes into account inflation. Everyone just looks at these charts without inflation, You cannot do that. You know, you're not really getting real returns if you're not taking into account inflation. And this is dividends reinvested.
Yep.
And I was just interested in looking at that slope from the 1950s, you know, up to that point.
Yep.
You know, after World War II. It seems very... we get these other slopes, you know, out of the 80s to 2000, and also now, that slope is very similar. But then you look how after those periods, how much of a flat period we get for a decade of, you know, even if you're reinvesting, dollar cost averaging,
you give it back.
Yep, you just sit there, and
it's
nobody
just a case
likes
of you've pulled
everything forward.
You've just pulled forward returns. And then, you have to have a shitty period for a while for those returns to come back down again. This isn't even. I like this chart even more.
Yeah, so this is exactly the same thing. It's just dividends aren't reinvested. So you know, if you're not reinvesting those dividends or dollar cost averaging, holy hell, does it get ugly? You know, you got decades of sitting there. You know. Couple of decades of going nowhere, and you're going backwards for a long period of time. You actually,
I'm glad I didn't buy in 1875.
Yeah, but everybody says, oh, if you put $100 in the market in 1875, you'd be a millionaire today. But they don't take into account inflation. And did you reinvest those dividends? Yes, you'd be up a, you know.
Yeah.
1,000x or whatever, you know, or whatever, 2,000x or 10,000x, you know, because of the log chart here, assuming you'd be able to hold, but no one takes into account, you know, the inflation and how much dividends mean to the market. At the moment, we've got, you know, like 1% dividend yield, or, you know, 1.5% or something like that for the in the US. So
that's on the
pitiful.
US.
Yeah, so I think it's under 2.
Yep.
Or it might be around 2 now, with the correction. But, you know, it's very low. And you think, wow, how many people are going to sit in here for a decade or two and be still interested about the stock market, you know? I just find it, you know, you look at how many years like this, and the average is 11%. You know, that's in the good years. That's excluding all the years where you're not going backwards or going sideways. So we just look at all those current years, you know, in recent memory, you know, you're getting those 14% returns, you know, to 2000 and 9%, you know, recently. We're just looking back at the last couple of years and thinking, oh, that's all going to continue. But, yeah, I'm not so sure. When people go and gamble in other areas or decide, oh, you know, I'll just leave my money in the bank. Risk-free return of 7%. I remember that, you know, not that far ago. Risk-free return of 7% in the bank.
Yeah. Yep.
Why would you, you know,
you could
sit
get
in the
that
market?
End of 2007, you could still get 7% in a fixed term deposit. That was right. 2007. Yeah.
So I just thought, that'd be interesting.
Yeah, I mean, it's just ugly to think about that, isn't it? Yeah. It's ugly to think about that 24-year period between sort of 66 and 82. It's just awful. Shocking returns. So, yeah, we could be in for another period of that. That's why I keep coming back to this idea of sort of buying, trying to get the bottom, the pivots. Like, these things can go sideways for a long time. They don't have to just bottom and go straight back up again.
It tells us to be patient.
So what
do
we got next? This is a screen that you've run recently. Yeah.
So I'm like, am I being patient, or am I just, you know, trying to go here and buy something? So I'm trying to be, instead of being a tight ass, you know, trying to buy 50-cent, you know, 50-cent dollars or worse. Trying to turn into a bit of a more Munger type investor, instead of a Buffett, you know, tight ass type investor. You know, and Munger's more into, you know, buy quality companies at a fair price, not junk companies at a fickin' bargain basement. You know, stuck with this junk company that you can't.
The reason
work
they're
out
a
when
bargain basement.
Yeah. And when do you sell them? Like, you know, how much pain can you actually tolerate? And will they actually turn around? You know, So I'm trying to change my mindset here, and this is how I'm trying to do it. I'm trying to look at high return on invested capital, and then instead of a DCF, trying to go to a price to free cash flow. I still can't,
Right.
bring myself to be paying 50 times free cash flow. This is operating free cash flow.
Cash flow.
Yeah, free cash flow. So, that's like money you're putting in your pocket. But I'm trying to understand this.
Yep.
And if you look at companies like Philip Morris here, okay, you got a price to free cash flow of 40, which is, if you convert that into a yield, us bond people, that's about a 2.5%, coupon that you would be getting. But then you go, oh, look at this dividend, you add 5.5% onto that. So you add, 2.5 plus the 5.5, you go, wow, that is a huge coupon.
Yep.
Obviously, you're in an industry there that, got a few headwinds. So how long do you hold this for? And so, that's how I'm trying to change my thinking. I'm still trying to keep the bond mentality.
I did.
Yeah, go ahead.
I was going to say, listening to Terry Smith talk about Philip Morris was interesting. That something that's obvious once he says it, but it wasn't. He said, like, isn't it? Who's the new entrant into this market? Like, why would there be a new entrant in this market where the number of smokers is sort of stable? I suppose maybe slightly declining or fairly stable, but. I mean, how do you differentiate yourself? Because you can't advertise anywhere. You can't advertise at all. Your packaging has to be plain packaging, and pretty much in the developed world. When you think, I never thought about that. It's like, well, how hard is it to make a cigarette? But even if you do make a new cigarette, you can't actually advertise it anywhere. So it's just
going to the board and say, "Oh,
isn't it?
Let's invest a couple of $1 billion into creating a cigarette brand." Going to the board and mentioning that. No one would let you do it. Right? There's no company in the world who go, "Oh yeah, let's invest a couple of $1 billion into a cigarette brand." So his thinking there is like crystal clear. And then you got the government protecting your monopoly. Like, they're tracking down everybody who sells vaping products or illegal tobacco. They're all,
Yep.
They're working for you to track down all your competition, that's trying to get around all the taxes. So, but out of these companies, there's obviously Philip Morris is a little bit hard to invest in. Especially if you don't like smoking. But
actually,
and then they've got.
You singled out the top two. Is that fair to say?
Yep.
To have a look at.
Yeah, because they've got such high.
So that's VeriSign
and FICO.
Huge returns on invested capital. Gross margins are huge. Operating margins, VeriSign's is huge, isn't it? So let's have a look at VeriSign
Valuation. Yeah, so VeriSign, they do the .com.
So what do they do? Just give us a brief.
Yeah, so they, like a tech company, but they do .com registration. So that's where they've got their value in the market. Yep. They run that, so no one else can run that, and that gets up for renewal every so often. So it's all sort of like a patent sort of thing. That's sort of your sort of moat. So at some stage that will come off. I haven't looked at the exact date that'll come off, but obviously these cash flow numbers and return on invested capital will get hit if they don't get renewed as the company that does all that. But you can see from the shares outstanding, they're buying back shares, so they're not like a degenerate freaking tech company that, creating 1 million shares every quarter. And the price to, free cash flow there, you can see it's 23, and in the last couple of years it's been in the 30s. So it is at a discount, I'm trying to, the old value type in me. But it can go down a bit further, you've got 17 in 2018 there, so you can come down a little bit more on those numbers. I've got the current price is 177, and the fair value I have it is 112. So
Yep.
it's a fair way off in a DCF,
Oh.
but at 100, yeah. So I'm only 10% discount rate on that. So yeah, but what do you think? What do you think of this sort of way of looking at things? Or what do you think of the numbers? And I know you return on equity.
Yeah, I mean,
guy.
Yeah. Well, yeah, I'm a return on equity guy if they've got no debt, and then it's if they've got debt, then it's you've got to take that into account. Why isn't there a return on equity there? Why isn't there?
I'm not sure.
An actual number there for return on equity. Yeah.
They're all blank.
But I mean, obviously, that return on invested capital. I mean, this is a very capital light business, isn't it? It's able to generate excellent returns on it. I mean,
and they've got a moat to keep.
What did you say? You used a 10%. Yeah.
Yeah,
right.
But I'm a bit of a degenerate
who knows how long.
In the free cash flow. I don't use free cash flow to actually create the growth of the free cash flow. I use revenue. So the revenue increase I'm using as the growth rate. Because I'm trying to be new age, with the kids. They just look at revenue. Revenue growth is the most important thing, I'm being told.
Well, that was the most important thing in the late 90s and early 2000s, eyeballs and revenue. I mean, in the last few years with all these SaaS companies, it's annualized recurring revenues, And, okay, yeah, but when does that turn into bottom line profit? When does it turn into, even, forget about profit when does it turn into EBITDA and positive cash flow? Because a lot of those businesses, I'm not going to name any, but they don't. There's not much there. You're waiting, because what you're waiting for as an investor is, I know everyone will bring up Amazon as the sort of exception, but what you're waiting for, when's the payoff come? When does those cash flows actually flow back to us? Because that's what we're paying for at the end of the day. A stock is just discounted cash flows delivered to you over time. So when does that come? And I think there's a lot of business models in the last few years where, yes, look at our revenue growth. Okay, and now in times like this, people are saying, well, that's nice, but where's your cash flow? Where's my dividends, or where's the cash flow coming back to me in the terms of reinvesting it and increasing my equity? So let's have a look at. So this is on your shopping list, but it will only be something you would buy if the price went significantly lower. Is that fair to say? Yeah.
So, I'm in the camp that things are going to go lower for the next 3 to 6 months, and buying now just means you're going to be buying at a higher price. I can't see earnings increasing from here, so I think there's more pain to come. I could be an idiot. This is not investment advice. So, this could come back and bite me pretty hard.
Of course.
Yeah. That's just what I'm sort of thinking, but you should have your shopping list ready. This is what I tell people.
Exactly. Yeah.
You can't be saying, I'll look at it when things go wrong. You're going to be in too much fear, and you won't have, what are your lines in the sand here, because there's reasons why there is heaps of fear, because it's a terrible time to buy. But if you're looking out past the 6 to 12 months, and it's just a blip, that people will get over, what are you going to buy and what price? I'm trying to buy some value. I want to have, be shopping, but not shopping at the bottom of the barrel. I want to be buying some quality stuff that I can hold for 5 to 10 years and forget about this market. And just
look through the volatility.
Let them, and just let them compound internally. And I'm not paying any taxes. Really, they're all internally compounding it. And come back in 5 years, and hopefully, sell out a bit, or I'll be getting dividends. Who knows what'll happen? So, that's the plan.
Well, let's have a look at the next one you picked out was FICO, which does the FICO scores for people, basically credit scores, isn't it?
Yeah, and very asset light again. So, you see these numbers look amazing in places, but does it have a moat?
Yep.
I see there's a couple of startup companies that, they're using AI to do credit scores and, stuff like this.
Right.
But if you're lending people, 60 grand for a truck, would you take an AI credit score, and hope that's going to hold you through, if you're a bank or a credit agency, I don't believe it's going to happen. I think they want people with a little bit of experience here. You don't want to be just outsourcing this to a freaking computer. But I could be wrong. I think FICO could go international. Like, I'm very surprised that we haven't got this sort of credit rating in Australia either. So it's got international expansion to some degree, I think. But it's not really popular here. It could, all the East, China and all those places, they could take this on. And so there's expansion. And you can see again, shares outstanding are just falling. You see the price of free cash flows.
So they're buying back stock.
Yep. Right. And you can see that price of free cash flow is looking brilliant. Could go down to 20. So that's that 20 to 25% correction in the market. Like, you really should be, looking hard. Especially if you think a recession.
So this is obviously
average 1 to 2 years.
Sensitive to, So this is sensitive to housing, obviously. Yeah.
Yeah. And so in 2008, this crashed. 70%. 60 to 70%.
Well, yeah, would have. Yeah.
So it got really hammered.
Yep.
But then, as you can see, how much it climbed out of there. So if you're thinking, oh wow, like that happened again, like something that's got a bit of a moat, a bit of a brand, capital light. I know other people go in the other direction. They want to go capital heavy because that is the moat. No one wants to invest because it's so capital heavy. But I don't know. It's a change in mindset. I think might happen here as well. But that's one of the ones I'm looking at. But I'm liking your next one even more. Like, so I think. What do you think?
On FICO. Or on
FICO.
I mean, on FICO, I would be waiting. Because we're just starting to see housing come off in the United States. Home sales and inventories building up, and so I'd want to see a bit more the extent of the damage in housing first before I had. But again, it's one of those you add to the shopping list, and it's an opportunistic buy if it gets a lot lower. Microsoft is I like it. I mean, I did a valuation on this with a 15% discount rate with estimates for the next 2 years. The consensus estimates cut significantly. I cut them significantly because I want to be conservative. 15% discount rate on Microsoft is probably excessive, to say the least. And I still got a valuation higher than today's price. Not much, probably about 10% higher. My question on, and this is one of these compounders that's had a great decade coming up to where we are. My question is that I think last year, I don't have the exact figures, do I? 2021, in 2022, that's operating profit. But net income, I think they pocketed about $72 billion. They paid out $18 billion in dividends, something like that, and they bought back 30-odd billion in buybacks. So earned 70, gave about 50 back. So, I mean, you and I are people that want to buy companies that earn high rates of return on their capital and then can reinvest those returns back into the business at those same high rates of return over long periods of time. Now, Microsoft, it seems to be giving a lot of capital back. So, I'm asking whether there is a lot of growth left in it. Now, traditionally, you know what they've done. They've just gobbled up other people, haven't they? Recently, they just gobbled up Activision for $68 billion. I don't know if that was haven't looked into whether that's a good price or not. Seems on the high side. I just had a look at Activision's previous year's net income. It seems to be a bit excessive, that price tag, but who knows? I mean, so I like Microsoft. It has been a compounder for a decade or so. Will it continue to be? Microsoft's been around a while. Is its days numbered? Is its only growth or real growth going to come through acquisitions? I mean, you have a look at their web services business, growing pretty well.
Yep.
They've got their enterprise software. I mean, everybody uses Excel, but it's so sort of things like, everybody uses Excel, but once upon a time, everybody used Lotus 123. I remember Lotus 123. I used it when my first job out of university, and then I had to go on an Excel course. But I mean, it's the unknown.
It's the ecosystem.
The known unknowns.
Yeah. So that's how they compound, is because they bring more and more stuff into their ecosystem, which then traps more and more people in there. So, for example, Office, that's all linked in now to all their online subscription stuff now. And I tell people, there's a free version of Office called LibreOffice. It's basically exactly the same, and people just refuse to use it. Absolutely refuse to use it. No, I've got to pay, whatever, $80 or $100 a year to use, Microsoft Office. I'm like, there's a free alternative, which is, 80% as good. And you're not, and the people who use it aren't going to use the extra 20%, So there's obviously a moat there. And
well, that's like, do you know the statistical package SPSS? SPSS?
No?
It's like a couple of $1,000s. So if you're running, if you're doing research and you want to do, you've got a control group, you can run all kinds of statistical tests and whatnot. Someone came out with something called PSPP instead of SPSS, and it's the same, only it's free. And for most people, it does what you need it to do, because most people aren't doing these intricate, So Microsoft. I mean, like I said, very conservative. It looks good to me on a valuation basis. I'm going out of my way to look for reasons not to buy it, and I don't have any great reasons not to, except are they? Because given that they're giving back so much capital. Do they have the ability to continue to compound returns for the next decade? That's sort of the question I'm asking. I
looked at their cash from operations. That's about $90 billion. They can buy this Activision, $68 billion, pretty easy, and they can get they can buy debt. Debt would cost them nothing, because they're such a big name. And so even their free cash flow, is $65 billion. So just 1 year's free cash flow, they could buy Activision, the whole lot of it. So they become an acquirer, sort of like the old conglomerate, many years ago. But they're buying things that fit into their ecosystem. So Activision fits into their Xbox, and they get these, how they talk about all this bullshit about synergies and all that crap, but there actually is a little bit of that in this, going on. You can imagine all the office people, all the back office, that'll all just get partly folded into Microsoft, and you imagine what they can do with cross promotion and things like that across platforms. It'd be pretty powerful for them. So I'm a little bit, this is going to be a good buy. But you still got that arbitrage as well. You can buy Activision today at 20% discount off what Microsoft are going to buy it for in 12 months. So if you want to make a 20% return, and you think the deal's going to go ahead, buy it today. But I'm greedy. That's one of my problems. I think I can make more with a crash going on, and between now and 12 months. So yeah, it's not something that I'm going to go into. But yeah, again, Microsoft is that, it's a 20 price to free cash flow, so that's a 20% coupon, and then a 1% dividend yield on top of that. So you're getting a 6% return that's coming back to shareholders, and you're thinking, wow, that's pretty decent for a blue chip type company that's, I think, has still got it. It does some terrible investments, but look at Skype. What a dump that was. And they and they missed out on some stuff as well. Like, they didn't pay for YouTube. They could have outbid Google and got YouTube. That would have been and I complained about Google buying YouTube. $1 billion. What a fucking rip-off. And it's been the best acquisition in the last 50 years. It shows how much I know, but you just can't pick these compounders sometimes, But if they continually got a moat where they can fly off all this free cash flow, and then they can have a few bets,